And we'll start by sharing the slide presentation. And just if anyone is unable to see it or download it or have a copy of it, in the chat room, put down your email address, and then after the presentation, I'll make sure that we email the presentation to you so you have a copy of it. Good morning, everyone. My name is Mark Stone. I'm the managing partner of Sales Tax Defense. Our firm specializes in sales and use tax consulting. I'm a CPA. I have a master's in taxation. I also used to be a sales tax auditor for New York State. My partner, Jennifer Koo, is an attorney if you need legal help on this end. And we handle everything from advising clients what to charge tax on, where to charge tax, how to charge tax, to taking things up to Albany through the entire court system, up to the appellate court in Albany when the government says something should be taxable. And our clients, and in conjunction with our clients, we agree that the transaction is not subject to tax and that the New York State Tax Department got something wrong, and you shouldn't be paying tax on the transaction. So today's presentation is really all about e-commerce and sales tax on the internet, or sales tax remotely. That's really the way to look at it, because sales tax itself on the internet is very, very simple. It's the rules around it on what you have to do to stay in compliance, which is much, much more complicated. So let me start with some basic rules. Let's go to the first page, actually. In New York, why do we even care about New York sales tax? What do we do that we have to follow the rules? Why do we have to follow the rules? Well, every state would like for every business to collect sales tax and send it to them. But most businesses don't collect sales tax in all 50 states or the 46 states plus District of Columbia that have sales tax. They only collect sales tax and remit sales tax in 1 or 2 states. Why? Because that's all they have to do. They don't have to do it any other place. And that comes about from a 1992 Supreme Court case, Quill versus the state of North Dakota. And what the Supreme Court said is that you have to have a physical presence in a state in order for that state to regulate you. That connection, that physical presence, is called nexus, N-E-X-U-S. And what nexus basically means is that you have a connection to a state, and since you have a connection to the state, that state can regulate you. And let's just stay with New York for now. New York says that our law is that there's a sales tax or a use tax, and that you, the business, have to collect the sales tax on certain transactions. And what it also says is that if you're a purchaser and for some reason the seller didn't charge you sales tax, then you have to pay a use tax directly to the government exactly equal to what the sales tax would have been, but that you didn't pay. And the use tax is supposed to be the safety net, if you want to call it that. For anyone that beats sales tax, you get stuck as the purchaser paying an equal amount of use tax. So even if the seller makes a mistake, you, the purchaser, don't get away from paying it. So we're very used to this physical presence test, because I'm going to make the assumption that 99% of the people on this call have a physical presence of their business in New York. Therefore, they have nexus in New York. Therefore, they have to follow the New York rules, which is, when applicable, collect sales tax, obviously remit the sales tax, and file a sales tax return. So here's the most important thing that I'm going to say in the entire presentation for the next hour. And if you only remember one thing that I say, this is it. Every business, which means every single business, which is every single solitary business without exception that's located in New York State, should be filing a New York State sales and use tax return. There are no exceptions to that. And you're going to tell me, well, I'm a teacher and tutoring isn't taxable. I'm a clown and I entertain children at birthday parties. That's not taxable. There's reasons for all of those different types of professions, whether you're a doctor, a lawyer, an accountant, a clown, a tutor, anything else, to be registered for sales tax, and at a minimum, filing an annual 0 sales and use tax return. What that does is it starts the statute of limitations, and if you made a mistake, if the clown forgot to pay sales tax or use tax when the clown bought a big red nose, if you're an accountant and you bought your laptop computer out of state and that seller didn't charge you sales tax and you forgot to pay use tax on it, it only gives the government 3 years to come back to you and say, whatever you did that was wrong is wrong. After 3 years, the book closes and the government's not allowed to change your tax return absent criminal fraud, basically. Short of them showing fraud, they can't reopen your books. So 99.9999999% of the time, unless the district attorney gets involved, if you're filing returns, the government has 3 years to audit you and make a change. Otherwise, it's closed and done. So that's the most important thing to remember, that every single business should be filing a sales and use tax return. And not just in New York, but in any state where you have nexus. So again, it's just staying with physical presence. If you have an office in New York and you have a satellite office in New Jersey, now you have physical presence in 2 states. So you need to now file in 2 states. And physical presence can come about from not just having an office, but it can come about from having traveling salespeople or service technicians traveling from state to state to state to do company business. It can come about from storing inventory in lots of different states. And that's a very important thing to remember, storing inventory, because we're going to come back to that in a little while. That's probably the biggest thing that's going to create a problem for a lot of people on this call, is the storage of inventory that you never really gave any thought to. Or any other type of physical presence in a different state creates nexus. Maybe going to a trade show, maybe flying out to train a new customer or do a software installation. All those different things create nexus. Nexus doesn't mean that you need to collect sales tax. Nexus just means you have to follow the rules. Until you have nexus, until you have a connection with the state, you can tell a state to go jump in the lake because they have no right to regulate you. If you got a bill from Russia saying that you need to pay Russian tax on something, you would throw the letter in the garbage. You would say Russia has no right to control me. If you get a letter from a state where you don't have nexus, you can do the same thing. You can basically ignore them. They have no right to regulate you. Once you have nexus, once that nexus comes about from a physical presence, or now being a remote seller, the internet, now you have to follow that state's rules. You might not have to collect tax on your transaction, but you must look at the rules in that state. You must make sure you understand the rules. Just because New York says that a loaf of bread is not subject to sales tax when you buy it, that doesn't mean Virginia says that a loaf of bread is not subject to sales tax when you buy it. So now you have to figure out what the rules are for your Virginia supermarket and not follow the rules that you're doing in your New York supermarket. Very, very important. So that's the baseline. That's physical presence. That's what we all know. That's what we live with. That's brick and mortar stores is the expression. So what's changed? 2 years ago was a dramatic change in sales tax. So when it comes to the tax world, we'll call it a sales tax earthquake because it's been the biggest news since 1992. 2018, close to 30 years later, not quite 30 years later, the state of South Dakota went after 3 different companies. They went after Wayfair, they went after Overstock, and they went after Newegg. And what they said is that we don't care that you don't have physical presence in the state. You're doing enough business in our state that you have economic nexus, and that we're creating an environment for you that you wouldn't be able to make sales if not for the fact that we built roads, that we have policemen regulating things so things don't get stolen, that we have all of these state provided services that you're taking advantage of. And therefore, you have an obligation to follow our rules exactly the same way as if you had opened up a store here in our state. So Wayfair fought them, and Wayfair won against South Dakota in every single state court and every single federal court except the Supreme Court. In 2018, the Supreme Court decided the Wayfair decision. And what the Supreme Court said is a combination of two different things. Our 1992 decision of Quill was kind of wrong. And the reason that it's kind of wrong is that things have changed so dramatically with the creation and evolution and economic transformation that's taken place because of the internet, that it's not applicable law anymore. That this concept of economic nexus now being the same thing as physical presence and creating physical nexus is allowed. And they reversed themselves. They reversed the 1992 Supreme Court decision. And they said, now this is the law. And what the South Dakota law says is that in the preceding 12 months, if you've done either, excuse me, either $100,000 of sales into the state and or 200 transactions in the prior 12 months, from that point forward, not retroactively, from that point forward, you now have nexus in that state and you have to follow that state's rules. So now what do you do about that? So I have a couple of practical things that I think you have to do. I would say twice a year, you look at your sales. You run the sales by state for the last 12 months. You do that on December 31st and you do that on June 30th. And you look at your sales, and in any state where you have $100,000 or more of sales in that 12-month look back, you now need to get registered. I think it's unrealistic that you're looking at your sales every month or every day for all 50 states. I think it's going to just make a very burdensome administrative process. With regards to the transaction count, you should know that 200 transactions on the look back period also create nexus. However, the cost of administering sales tax for yourself, of registering, of collecting, of filing returns can be substantial. So if you're selling gumballs and you charge $1 a gumball and you sell 250 gumballs into a state, so you don't charge sales tax on $250 and sales tax is 10%, and the state sends you a bill for $25, you don't really worry about it. You pay the bill, and then maybe from that point forward, you do it right, because it's going to cost you a lot more than $25 a year to file returns in a state and be compliant in a state. So I like looking at the dollar threshold much more than the transaction threshold. However, if you do have lots of higher ticket dollar transactions, they're $500 a transaction or $350 a transaction, maybe you do want to be a little bit more careful with that. And if you have thousands and thousands of transactions that add up to something significant, you also want to be careful with that. But if you just have, again, 250 transactions and each transaction is $10, so it's $2,500 in sales, if you get a bill from a state for $250, it's probably not the end of the world. So you have to balance what you are supposed to do for compliance versus the cost of that compliance and the cost of non-compliance. So that's the first part of it, that there now is something called economic nexus, and that may create a requirement for you to collect, file, and remit sales tax in multiple states, multiple jurisdictions. Okay. The next piece that goes along with this, again, this is all remote sellers, internet related. It's next to impossible for a state, let's just pick on Texas, for example, to track down every New York company that's doing 201 transactions into the state of Texas. There's just no realistic way for them to do that. And you know what? There's no realistic way for them to enforce that, because if they're going to be sending out bills for $250, it costs them probably more than $250 to send out that bill, to track it, to collect on it, to keep it in their computer system. So they don't want to do that either. So a lot of states have come up with a rule that says that marketplace facilitators now have to collect the sales tax for their sellers. The best example of a marketplace facilitator is eBay. eBay actually doesn't sell anything. eBay, I'm going to call it, is a dating website. It brings buyers and sellers together and makes a match. And then they take care of processing basically the exchange. eBay uses PayPal or some other payment mechanism to collect the money and then remit it to the seller. And eBay kind of administers the whole thing to make sure that everybody plays relatively fairly. What the states say is that the marketplace facilitator actually needs to collect the sales tax on the sale and remit it. So if you're a New York business and you're selling on eBay and eBay then collects the tax from New York State, what you do is you report your sale through eBay as a non-taxable sale for resale, because eBay is the person collecting and remitting the tax. And this way, if someone wants to do an audit, they have to audit eBay. They don't audit a million little sellers, they audit one company. And that makes it much easier for the governments to regulate everything. And eBay is not the only marketplace facilitator. Etsy, Amazon, in some cases, is a marketplace facilitator. But lots of different companies that have platforms that connect buyers and sellers are marketplace facilitators. And if you are a marketplace facilitator, you must understand the sales tax laws, because if you don't do it the right way, you're taking on the sales tax responsibility for hundreds, if not thousands of people. And sales tax is a fiduciary responsibility that you're personally liable for. And that can result in a bill to you of hundreds of thousands of dollars of money that you've never collected that other people were supposed to pay, and now that you get stuck paying. So if you don't know what the rules are and you're a marketplace facilitator and you're not following them, please reach out to me after this presentation. It's really something to be very careful of. The next big thing, fulfillment services. Everybody's heard of Amazon, or at least I'm going to make the assumption everybody's heard of this little company called Amazon. Whether Jeff Bezos is the richest person in the world or the second richest person in the world, he's doing pretty well for himself. He came up with this concept that Amazon would set up a big warehouse out in Washington State and then sell all over the country. And it's grown and grown and grown and grown. And by now, Amazon's biggest source of sales is that they provide fulfillment services and they actually sell for other people. So, and the amazing part of Amazon, if I want to sell coasters that are sitting here on my conference room table, they're going to get it to the customer in a day or two. Whereas if I was shipping out of my Dix Hills office here, and I had a customer in Los Angeles, it might take me a week to get my coffee coasters from New York to Los Angeles. So how does Amazon get it there in 1 or 2 days? And they get it everywhere in the country in 1 or 2 days. Well, if I want Amazon to do my fulfillment for me, so I don't need a warehouse, so I don't need people picking and packing these things, and this probably applies to lots of small businesses that are listening to this presentation right now, you send your inventory to Amazon. Amazon says to you, I need 500 coasters. And you ship it to a location currently in Pennsylvania, pretty soon in New York. And then New York takes your 500 items and breaks it into 50 lots of 10 each. Or really, they break it into about 30 lots of about 10, of 10 or 15 each. And they ship it all over the country. And they store your inventory in Amazon's 30 or 35 different distribution facilities all over the country. So now what do you have? You have your inventory in 35 different states. That's nothing to do with the internet. That's an old-fashioned 1992 rule that's still in effect, that you have a physical presence in 35 states. You now have Nexus in 35 states. You now have an obligation to file, collect, and remit as applicable in those 35 states. Now, Amazon will collect the sales tax for you if you're a FBA seller, but they won't remit the sales tax for you. They turn it over to you, and then it's your job to get it to the states where they've collected the tax or where you've turned on tax collection. Again, though, you may not want to be filing an annual return in the state of Wyoming to remit $6 in Wyoming sales tax. So therefore, you may take the risk and turn off sales tax in Wyoming and only want to comply maybe in your biggest states, New York, Florida, Texas, California, and Illinois. Those are typically the 5 biggest states that you have to worry about. Everyone's business is unique. It's important for everyone to do it the right way. But again, you have to weigh your costs of a $6 sales tax return versus the cost of registering, filing, tracking, bookkeeping, and then remitting that tax to Wyoming. So you have to make a business decision there. So Ronnie, at this point, are there any questions that we should be addressing?
I don't see any. Nope.
I've got one from Delia.
Oh.
Yes. Hold on a sec. Okay. She is a reseller. Can you guys hear me?
Yes.
Okay. She is a reseller for manufacturers, contract manufacturers, government, and defense. She buys the product mostly out of New York State and sells it to other states. However, the volume are never bigger than 20,000 total per year. She sent her resale certification to her vendors out of state, and it gets shipped out of the state. Since it is a non-inventory product, what is the proper way to handle the sales tax when she buys from the vendor and she sells it to her customers? She requests their tax exempt out of the state and for New York customers, if it applies. Thank you.
That's a great question. And you spent a lot of time typing that too. So
I forgot to mention, she says she's an S Corp and she's a reseller wholesaler for electronic components. Does that make a difference?
okay. So first thing, whether you're an individual or a DBA or a Schedule C or a C corporation or an S corporation or an LLC or a partnership, those are all basically income tax concepts and generally have no bearing on sales tax. Sales tax just applies to whoever the seller is. So the piece of that is point of delivery. Sales tax is governed by the point of delivery. So if you're shipping to New Jersey, New Jersey sales tax applies. If you're shipping to Texas, Texas sales tax applies. If you're shipping to New York, New York sales tax applies. So that's the first piece of it. The second piece of it, which we were talking about romper room before, because some of us are a little bit older than others of us. There's another word that I want to throw out there. You used the word wholesaler. So whenever anyone says to me wholesaler, I always say the word snuffleupagus back. And for those of us that are a little bit older, we remember who Snuffleupagus is. Snuffleupagus was Big Bird's imaginary friend. Big Bird was the only person who could see Snuffleupagus because Snuffleupagus did not exist. There is no such real thing as Snuffleupagus. There is no such thing as a wholesaler. It's an imaginary term. It does not exist in sales tax language. There's no such thing as a wholesaler. Everyone is a retailer making sales, and those sales are taxable unless you have a reason for those sales not to be taxable. So in this business's case, they have a manufacturer. It doesn't matter whether it's one contract manufacturer or 100 contract manufacturers, but it sounds like the manufacturers make something, and let's pretend the manufacturers sell it to them. I'm going to cover both sides of this. And then they resell it. So the manufacturers need to charge them sales tax based upon where the manufacturer ships it to. That company has a right, the purchaser always has a right to give an exemption document. That exemption document is most likely going to be a resale certificate. So therefore they become a reseller as far as the manufacturer is concerned. So now this company is the seller. They don't pay sales tax on their purchase from the contract manufacturer. And now they ship it out and they sell it to someone else. When they sell it to someone else, wherever the point of delivery is for that someone else, they need to charge sales tax unless the final customer gives them an exemption certificate that's allowable in the point of delivery. So to kind of give an example of that, you have a New York company, you have a Nevada contract manufacturer, and the customer is in New Jersey. So the customer calls me up in New York and says, I want to buy a pen. I call up my contract manufacturer. I say, make me a pen. They make a pen. And now from there, one of two things can happen. They can ship it to me in New York, or they can ship it directly to the customer in New Jersey. When they ship it directly to the customer in New Jersey, that's called a drop shipment. If they ship it from Nevada to me in New York, they're going to say, I need to charge you New York sales tax. I'm going to say, wait a minute. I'm a registered New York sales tax vendor. Here's my New York resale certificate. And don't charge me New York sales tax. Now I have the pen here in New York. I ship it to New Jersey. And I say to my New Jersey customer, all right, I need to charge you New Jersey sales tax because that's my point of delivery, unless you give me a New Jersey certificate. That's how that would work in the first scenario. The second scenario would be the New Jersey company customer calls me, I call my manufacturer in Nevada, they ship it directly to New Jersey. Now the contract manufacturer says, I have a New Jersey sale. They look to whom is paying them. So whomever is paying the manufacturer in Nevada either has to pay them sales tax or has to issue to them a New Jersey resale certificate exempting the transaction that was delivered into New Jersey. And then in the last possible scenario there, maybe you're just a commissioned sales agent and you make a sale for the Nevada manufacturer. The Nevada manufacturer sells the item directly to the New Jersey customer. The New Jersey customer either has to pay them New Jersey sales tax or give a New Jersey resale certificate. And since I'm just a commissioned sales agent, the Nevada manufacturer will pay me a commission. Commissions are not subject to sales tax. They're more in lines of a royalty, and generally commissions and royalties are not subject to sales tax in any state. Okay, so you want to go to the next slide? I can. So I want to kind of just reiterate this because this is, again, the key to the whole thing. There's two completely different issues. The first issue is nexus. Do I have to follow the rules? How am I connected to that state? What am I doing that allows that state to regulate me? And that's my example going back to Russia. Russia mails us a letter, we throw it in the garbage because they have no right to regulate us. Once we have a connection to that state, whether that connection comes from having an office or employees or traveling salespeople or storing our inventory in that state, or from having an economic nexus, which again is that $100,000, 200 transaction threshold. Whether I have a connection because I'm a marketplace facilitator, or the one other thing that I didn't touch is because I have an affiliate in that state soliciting sales on my behalf, or that I'm paying some type of commission for, that can create nexus for me in that state. And then I have to follow that state's rules. The second question is, now that I have nexus in the state, now that I have to follow the rules, what is the taxability? Do I have to charge tax? Is it exempt? Do I just need to get an exemption certificate? Am I not allowed to accept an exemption certificate? So there's all sorts of different rules that play into it once you have nexus in a jurisdiction. So keep those two things very separate. First, do I have to follow the rules? Then only if I have to follow the rules, what are the rules? Okay. So moving on to the next slide. So how do I follow the rules? This is the very burdensome part about everything. So every state needs to keep track of who's doing business in the state. So there's a number of registrations that need to take place. The first registration is that you need to register with that state's Secretary of State in order to be allowed to do business there. And every business generally has a home state. So if you're a New York company, you're a New York domestic company with the New York Secretary of State. So in order to register to do business in New Jersey, you would have to register with the New Jersey Secretary of State as a foreign corporation. Foreign doesn't mean overseas. Foreign just means that you weren't initially set up in New Jersey. That's all that that would mean. In order to register as a foreign business doing business in the state of New Jersey, you need to go to your home state's Secretary of State and ask them for a certificate of good standing to send to the other state, the foreign state's Secretary of State. Now you're registered in New Jersey and you're allowed to do business in New Jersey, and you realize that you have an obligation to file sales tax returns in New Jersey. Step 2 of that process is now going to the New Jersey the New Jersey Division of Taxation, the New Jersey Tax Department, we'll call it the IRS of New Jersey, and doing a second registration with the New Jersey Division of Taxation saying, I would like permission to collect and remit sales tax in New Jersey. So that's just getting registered. And you should expect to spend somewhere between 2 and 4, maybe 2 and 5 hours getting registered with the Secretary of State, and very similar, probably between 2 and 4 hours getting registered with the tax department in that state. So you probably have a day's worth of work filling out forms and getting the supporting paperwork just to get registered in each state that you're going to do business. Maybe if you're registering in 10 states all at the same time, you'll have all the paperwork in front of you. It won't take you 10 days, but it'll take you a couple of days to get properly registered everywhere. All right, now I'm registered. The next step is I need to collect sales tax. How do I collect sales tax? Well, you just add it to the bill. But how much sales tax do I add to the bill? So again, let me use New York as the example. So New York has basically a different sales tax rate in every county. So a lot of us are here on the island. So we know that in Nassau and Suffolk, the sales tax rate is 8 5/8%, 8.625%. However, in Queens and the 5 boroughs of New York City, the sales tax rate is 8 7/8%, 8.875%. 8.8, yes, 75%. I think that's what it is. So along those lines, how do you know whether your customer, the point of delivery, is located in Nassau or Queens? Well, we live here. Maybe we can, just from our own knowledge, figure out whether Little Neck is in Nassau County or in Queens. Maybe we can figure out whether Farmingdale is in Nassau or Suffolk. But what happens when we go upstate and now you start getting addresses that are in the middle of the forest, in the middle of New York State? A lot of us from downstate are not going to know what county those addresses are in. And now if you have nexus in the state of Texas, if you have nexus in the state of California, you certainly don't know all the different cities and transit jurisdictions and counties in Texas and California that make up all of their different sales tax rates. Maybe you get lucky, it's a state like New Jersey or Connecticut that have a single statewide sales tax rate that makes it much better. But most of the larger states, New York, Florida, Texas, California, Illinois, have either city-specific sales tax rates or county-specific sales tax rates. So you need to find a way to come in compliance with that. So there's ways to estimate that you get it 95% right. 95% right is still 5% wrong, but 95% right is better than doing nothing. So we could talk about that offline if anybody has any questions. Or the alternative is just to do it the right way. The right way is either to let Amazon collect the tax for you. They know the right tax rates. Go out and buy a piece of software. There's a company called Avalara that integrates with your billing system that will help you collect the right sales tax rate. There's other programs called TaxJar, Vertex, Taxware, all that do similar things. All of those software programs on the low side cost thousands of dollars to do. More realistically, probably cost tens of thousands of dollars to do. So you have to make sure that it's worth the investment for your size business to do it 100% correctly. But if you have nexus in a jurisdiction and you fail to collect tax when you're supposed to collect tax, the state, whatever state it is, does have the right to come back to your business and say, we don't care that you didn't collect it. You still had an obligation to pay it. Therefore, you owe us the tax, you owe us interest, and you owe us penalties on all of that money that, that you should have collected and remitted, but never did collect. So you figure out a way to collect the right amount of sales tax. All right, or Amazon collects it for you and sends it to you. Well, now what do? You're not allowed to take that money and go to Atlantic City with it. You're especially not allowed to do that now during COVID. So therefore, you need to find a way to get that money to the state. And you can't just send the state a check, because as much as probably Cuomo would like to receive checks in the mail, if he doesn't know what to do with the money, it's just going to create more problems. So obviously you have to file a return with the remittance. And so how do you do that? So again, you either need to download the paper return and go through your accounting system and accumulate the data, and then figure out where it goes. Because again, if it's New York State, there's a line for Suffolk County, there's a line for Nassau County, there's a line for New York City. So you need to figure out where to put your sales and where to put the amount of sales tax that you've collected. Or, again, you need to buy software from Avalara or TaxJar or somebody else that will file the returns for you. Or you need to hire a professional, your accountant, my firm, someone that can then file the returns for you, possibly like we can take your sales data in an Excel file or an export it to a CSV file and use that data and use our own software to prepare and file the returns. And then of course to remit the tax. Generally remitting the tax now is all done electronically. You give the government a bank account number and a routing number, and they pull the money out when the return is processed. So that's really the big parts of staying in compliance. Of course, you need to know what to charge sales tax on. That's very important. You cannot assume that just because I charge sales tax in New York, that I charge sales tax in another state. And even more so, you cannot ever assume just because I don't charge sales tax in New York, that I don't have to charge sales tax in another state. If your customer doesn't want to pay tax, they need to give you exemption documentation. It doesn't matter. It's not your job to be the sales tax police. If your customer gives you an exemption document, as long as the exemption document looks valid, as long as it's completely filled out, as long as you take it in good faith and you receive it timely, which is generally within 90 days of the date of sale, but I'm telling you that you should get it by the day that you sell something, the day you do the invoicing. The government is generally going to hold you harmless because you got the documentation, and they're going to go after the customer, the purchaser who didn't pay the tax. Keep in mind that if you have lots and lots and lots and lots of non-taxable sales, you're going to end up reporting to the government, to make up a number, $1 million in gross sales, $1 in taxable sales, and $999,000 in non-taxable sales. Well, the government is likely to audit you because they're going to want to understand why you're never charging sales tax. And they're going to see if they can catch you either playing games or not keeping the exemption documents. So that's why that paperwork is really so important. You really want to either charge the tax or get a valid piece of paperwork. Very important. Ronnie, are there any additional follow-up questions at this point?
Oh, yes, there are.
Yes, there are tons of questions.
Okay.
Tons. I even have questions, but I'll let the people ask theirs. Where should we start? Let's see. I'm going to go back up here to one of the first questions. Did you answer this one from Amy? Leslie, did he answer this Amy one? Would,
No, I was going to start with Rosa. Did Amy
well,
say?
Amy is before, would you be able to explain how it may work for remote virtual consulting slash coaching? I don't know what async is and sync online courses. I think it'll be less than the threshold for economic nexus. Amy, can we unmute her and let
Well,
her ask?
Ronnie, I think I understand the question.
Okay,
So basically, it doesn't matter what type of remote business you have, whether you're a consultant, whether you're a coach, whether you an educator, doesn't matter. You have a customer. Wherever that customer is physically at is your point of delivery. You don't care what the rules are until you have $100,000 of sales into that jurisdiction. Once you have $100,000 in the preceding 12 months of sales into that jurisdiction, you now have nexus there. Once you have nexus in that jurisdiction, you need to now figure out whether the product, the service that you sell is subject to sales tax. If in that jurisdiction, that product or service is subject to sales tax, you now need to, from that point forward, the point that you've exceeded $100,000, you now need to start charging sales tax. If you have $100,000 of sales into that jurisdiction and your product is not subject to tax, I would recommend that you still register and file an annual zero sales and use tax return to get the statute of limitations running. Okay, so that's that question, I think, Ronnie.
okay. So I guess just to say, if people have additional detailed questions, can they reach out to you?
Yes, they can call me, they can email me. I think at the end of the slide presentation is my email address and phone number. And you know what, I'll have it typed into the chat just in case someone doesn't have the slide presentation.
Okay, so I don't know if this was answered, but I'll just read her question anyway. Rosa asks, what's the difference between a business that provides a service or a business that charges clients by commission?
Well, a
Really
business,
think it's
you
applies.
charge, whatever you charge is how you charge. Certain products are taxable, certain services are taxable. Commissions are just another form of revenue. To the best of my knowledge, commissions are one of the few things that uniformly, so I'm going to say 99% of the time, not 100% of the time, are not subject to sales tax. That's really the only difference. It's all revenue. It's your responsibility, if you're receiving revenue, to know where that revenue comes from. If you have nexus in the jurisdiction where it comes from, follow that jurisdiction's rules. So therefore, you have to look up what the rules are in that jurisdiction. That's all.
I think you've answered this question too, but I might as well ask. Kimberly wants to know that says that she's been contacted by a company that wants to hire her to generate content for their Instagram and website. And she wants to know if she owes sales tax.
Depends on what state. So, and even if it is taxable in the state where you're going to be delivering it, if you do less than $100,000 of sales into that state over the preceding 12 months, if you don't have physical nexus, you can ignore the rules and not worry about it. However, your customer, the purchaser, if it is subject to tax in that state and you don't charge them tax, they owe a use tax equal to exactly what the sales tax should have been, but wasn't paid.
Oh, okay. I have a lot of questions about use tax, but I'll wait another time to ask my questions. But here's a question from Melissa. She says she's recently opened an online store on Shopify, and she'll be carrying wellness products of all kinds from different brands, different vendors. I will not carry inventory, and each brand that she partners with will be drop shipping to customers. So she wants to know about her responsibilities, which I think you've covered this already, but
well, she's in the true nightmare scenario of sales tax. So she's doing drop shipments. So her suppliers may need multiple resale certificates for multiple locations. She'll probably have an obligation to charge sales tax in multiple jurisdictions. And health and beauty supplies are something that have very, 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 very different sales tax treatments in every different state. In New York, for example, just to give a very basic example, shampoo in New York is subject to sales tax. Dandruff shampoo, because it has a medical use, is not subject to sales tax. In New York, chocolate milk is not subject to sales tax because it's a food. Yoo-hoo is subject to sales tax because it's something other than food. Those are very New York specific rules. New York taxes chocolate covered pretzels because it says it's candy. California says chocolate covered pretzels are exempt because they're a bakery item. So health, beauty, wellness items are really among the worst of the sales tax treatment things, that there's no consistency whatsoever state by state.
Thanks. Okay, so Rosa wants to know, if she opened a business in 2018 but had no clients, no customers, does she still need to file sales tax? File her sales tax?
Probably should have, but her exposure is sales tax times $0 in sales, which gives her $0. So
Right.
that's water kind of under the bridge. Again, really looking to getting into compliance from today forward. I'll talk briefly if we have time about some historical stuff, but if we don't, really, if nothing else, fix it today going forward.
Right. Okay. Eddie says he has a client who was incorporated in 1950 but never registered for sales tax. Should they register now, which is what you just answered, or will that cause a problem with New York State looking into it further? But I think you just answered that question, but go ahead.
So that would really lead into the next topic that I want to talk about. So I'm going to come back to that unless there's no more questions.
Well, there's another question from Helen. She sells on Etsy. Etsy collects, we know, and remits sales tax. Does she still need to register and file sales tax? She started selling in September of 2020.
So I'm going to go back to what I said when I first started. If there's only one thing that you need to remember from this seminar, is that every business, which is every single solitary business without exception, needs to register for sales tax and at a minimum file an annual 0 sales and use tax return. So no one else is allowed to ask me that question.
I did not know that. I'm doing this for 20 something years, and I didn't realize that every single business needs to register.
It's not a law. It's a very, very, very smart business practice.
I see. Okay, that's interesting. All right, so continue. We're good now.
No,
I think we don't have any other. Wait, we have more? I didn't see
the direct message. Ileana with an E. Did you get your answer? Your question was, if there is an online business, do you have to register sales tax on each state?
On each state where you have nexus would be answer to that. Again, those are the rules. You only have to follow the rules where you have nexus. Nexus comes about from $100,000 in sales. Once you have $100,000 in sales, you have to follow the rules. The rules are always to register.
Okay. And Helen Arbuckle, I believe she got her answer.
Yes, we just asked her question.
She direct messaged me, and everyone else went under everyone. Oh, Delia says, so the threshold is 100,000 for sales taxes in every state?
It's 100,000 or more. There's a few states that have higher thresholds. Specifically, Texas and California have $500,000 thresholds. I believe New York has a $300,000 threshold, and I think Connecticut has a $250,000 threshold. But what I advise clients is, like I said, twice a year to look at their sales by state. For the states that they have more than $100,000 of sales in the preceding 12 months, then you need to talk to somebody and probably get registered. If you're looking at one of those few states that have a higher threshold, when you actually go to look at it, then I would say, all right, you're doing $150,000 in California. Their threshold is $500,000. You can wait till you have more sales. But it's typically $100,000 in sales or more. That's what you need to look at it.
Okay, I've got one more from Eliana. Is bookkeeping services taxable in New York?
No, bookkeeping services are not taxable in New York.
Okay.
I'm
Okay.
still interested in the $100,000 threshold. So if you have sales in a state under $100,000, you
You can
don't
ignore,
have to,
you can ignore the
you,
state.
you ignore the state. Okay. Okay. All right. Continue, Mark. Go ahead.
Okay, so going back to that company that was incorporated in 1950 and has never filed a sales tax return. So first of all, congratulations for being in business for 70 years. That's terrific. The second piece of that is if they're doing it wrong, you can't continue to do it wrong. At some point, they're going to get caught if they're doing it wrong and they're going to get a big bill. In addition, if you're the accountant and you know your client's doing it wrong and you don't fix it, when they get caught, they're going to sue you for malpractice and it's your fault because you knew they were doing it wrong. So how do you fix it? Well, you have to figure out, do they have exposure? If they never charge sales tax and they never had a need to charge sales tax, I would say just register them as of today and then just go forward because you really have no exposure for the prior years. If they should have been collecting tax but didn't, the state can go back a long time and charge you an awful lot of money in tax, interest, and penalties. New York, like most states, has what's called a voluntary disclosure program. And you get what's called a VDA from them, a voluntary disclosure agreement. And this agreement from them says, listen, you haven't caught me. I want to clean up my act. I've been in business for the past 70 years. I haven't collected tax, but I realize I made a mistake. I agree to remit the tax that I should have collected going back 3 years. You agree to never look back more than 3 years. You agree not to charge me penalties. You agree to charge me the lowest interest rate that you're allowed to by law. And if I need, you'll also give me a payment plan. And that's a very good way to get a company into compliance that's been out of compliance but owes money. If you run into the situation where getting into compliance is literally hundreds of thousands of dollars or millions of dollars and will put the company out of business, then maybe we have to have an offline discussion about closing the company and starting a new company. Because again, you can't continue to do the wrong thing. And just doing what I call a quiet registration, just registering from today forward when you have millions of dollars of exposure may not be the right answer for that company. So that's something that we should really talk about in more detail. Okay. Oh, thank you.
Good.
The only other thing that I didn't cover was something called an offer in compromise. An offer in compromise is when you owe the government money and you say, listen, I understand they owe you $1 million, but you know what? My business went out of business. My in-laws are willing to lend me $250,000. I already lost my house. I went through a personal bankruptcy. I have nothing left for you to take. So your choices are to mail me a bill every year for the next 20 years, or do you know what? Let's settle. Let's do an offer in compromise, and I'll come up with $250,000, and you accept that as payment in full for the $1 million that I owe you. It's a complicated process with New York State. It works better when that liability is a little bit older, and New York State's tried to collect on it and they failed. Unfortunately, the more broke you are, the better the program works. Of course, you still need to come up with some money at the end of the program to settle with them. And when you're the most broke, which is the best time to settle with them, you don't have the money to settle with them. As business starts to improve and you go to settle with them, the amount of money they want to settle goes up. So it's kind of a catch-22 where really the best scenario is you're out of business, you're broke, and your in-laws are going to lend you the money. So again, and we can talk about something like that offline, how the best way there is to present that scenario to the state, because a lot of what goes into that is making the right presentation to the government to get them to accept your settlement.
So if you're incorporated and you're not personally liable, right? And you close the corporation, what happens then?
Sales tax and payroll taxes you are personally liable for, and sales tax and payroll taxes are not discharged in bankruptcy. So you still have to
Okay.
deal with it after the business. Okay. So the next thing is staying out of trouble. You know, if a state doesn't know about you until you're ready to, you know, be in compliance in that state, try to stay below the radar. Don't start applying for business licenses and permits in the state. Assume that all the computers are connected in a state. So once you put your name in one computer, it's in every computer in that state. So be careful about that. That goes along with filing for one tax type. Really should file for all tax types because you're clearly in the computer. And if the state mails you a questionnaire, nothing good comes from a government mailing you something. They don't send out birthday cards or thank you letters. Everything they send to you is always bad news. So when they send you a nexus questionnaire saying, are you doing business in our state? Make sure your accountant or your lawyer answers that. You can only get in trouble with that kind of stuff. You can't do it right. You can only do it wrong. So the best thing to do is really be in full compliance or try to avoid a state completely. So that's staying out of trouble.
All I can say is I think that there are probably people here who are quite nervous about what they're learning today. Go ahead.
Yeah, lots of bad news. So this is the good news, this page, the refund page, and I'm going to try to end on a good note. There are times that you can actually get sales tax money back. And when I say getting sales tax money back, in almost every case, it's when you're the purchaser, not when you're the seller. So when you purchase things and you use them in a specific way, a lot of times the government says you didn't need to pay sales tax on that. And just these are some 4 examples. If you're a contractor and you buy materials in New York, but then install them in another state, New York will give you that sales tax back on the materials that you installed in another state. In New York, if you buy machinery and equipment and you use it either in the manufacturing process or in the research and development process, or you have repairs or supplies or replacement parts to that machinery or equipment, that's all exempt from sales tax. You can get that sales tax back from New York State. New York has exemptions for printed promotional material. California has exemptions for startup companies. New York has exemptions for when you get money from the IDA and use that to expand your business. If you're a seller and you've remitted the sales tax on a sale and then ultimately your customer doesn't pay you, since you didn't get paid, you're entitled to get the sales tax back from the government since you never got that from your customer. Sometimes when you do business with exempt entities, churches, temples, school districts, fire departments, you don't need to pay sales tax on your supplies that you buy to do business with them. And then just a last thing, which is really staying out of trouble. Sales tax should really always be separately stated, and please separate as line items or on separate invoices the taxable sales from the non-taxable sales. On your invoice, don't say Yoo-hoo and chocolate milk $2. Say Yoo-hoo $1, chocolate milk $1. So the state doesn't have to guess what you're selling each item for. So these are some positive things, if there is such a thing as positive things with sales tax. And then on the very last page is a beautiful picture of me and how you can get in touch with everybody at my firm. So
That's great, Mark. I love your little, whatever it's called, avatar, I guess. I don't know.
sure.
That's cool.
Any last questions, I guess?
We have one more question in the chat box. Was there another question? Let's see. This was fantastic, Mark, although it does open a huge Pandora's box for a lot of people, I'm sure. I can think of a few people who should have benefited from this greatly, but there's a lot of questions that are still out there. You can reach Mark by his email or give him a phone call. He's very generously offered to answer any additional questions. So are there any more questions here? Please, Miranda wants to know if you can please clarify. I have this question too. Clarify use tax.
So a seller collects sales tax from the purchaser. If for some reason the seller forgets to charge the purchaser sales tax, for whatever reason, doesn't matter why, and the purchaser was supposed to pay sales tax on that transaction, the purchaser has a legal obligation to pay that tax directly to the government. When the purchaser pays the sales tax directly to the government, it's called use tax.
Okay. So Melissa says she's still not clear. She wants to know each vendor, I'm not sure would each vendor or partner will be responsible? I'm not sure what this means, sales tax, and I am exempt from this. Not clear. Would each vendor or partner
No,
with?
that she partners with. She says, each vendor I partner with.
I partner with. Okay, read it, Leslie. You read it.
Okay. Would each
I got it.
I partner
You
with
got it. Okay, he's reading it. Okay.
So there's only two possible sides of this coin. You're either the buyer or the seller in any transaction. There's no other possibility. You're either giving someone money or you're getting money. I'm sorry, you're either getting money from someone or you're giving money to someone. It's the only two possible business transactions that exist. So a vendor typically means you're giving them money and they're supplying something to you. Every vendor has an obligation to charge you sales tax. If you don't want to pay your vendors sales tax, the transaction either needs to be exempt by operation of law, you're going to a doctor and the doctor's services are not subject to sales tax, or you need to give that vendor an exemption certificate. That's it. So that's when you're giving money to someone. The flip side of that is you're getting money from someone. When you're getting money from someone, because you're the seller, you have an obligation to charge the sales tax. And you need to charge sales tax on every transaction, unless by operation of law you don't have to. You're a doctor collecting for medical services, or your customer gives you an exemption certificate. Keep it simple. That's all you have to look at. It doesn't have anything to do with partnering or anything else. If you're paying somebody, you want to give the exemption certificate so you're not charged sales tax. If you're receiving money from someone, you need to charge them sales tax on the money you receive, unless there's a reason to not charge them sales tax.
Mark, with the resale certificate, I know you can get it from your state Department of Taxation and Finance, but sometimes vendors, businesses offer you their own. They tell you to fill it out. They have that on file, right?
Well,
Then you don't have to do your own. You don't have to give them your own. They have
yes.
it. They offer it to you. Correct?
So correct. The vendor is receiving the money. So the vendor needs to collect tax. So whatever paperwork they want to not collect the tax from you,
Right.
is fine, because
that's up to them. Right.
Right. And if they give you the wrong paperwork, it's on them that they gave you the paperwork.
Mm-hmm.
If the government ever comes to you and you say, I gave a resale certificate, the government's going to say, I don't care that you gave a resale certificate. The government's going to say, show me that you actually resold the item. Because when you're the purchaser, giving the exempt certificate doesn't make it exempt. The true transaction makes it exempt. When you're the seller, the piece of paper makes it exempt for the seller not charging tax. Because there's no way for the seller to really know what you did with something. So as an example,
Right.
when a bar goes into Best Buy and buys a 75-inch TV set right before the Super Bowl, and the bar gives Best Buy a resale certificate, the resale certificate gets Best Buy off the hook from the tax. When the tax department audits the bar can't say, I gave a resale certificate. The bar has to show that they resold the TV set to somebody in order to avoid the payment of tax on it.
Right. Okay. Got that. All right. Kim has a question. She says she's got a very tiny business. She only collected $40 in sales in 2020. It's the first time she ever made sales, and she wanted to make sure that she was in compliance. The business is in New York State, registered. Seems like a very simple process to me. Just pay these taxes online.
So $40 in sales. I'm sorry to say you're going to Rikers and we'll come visit you.
Right.
Honestly, if you really did $40 in sales, I wouldn't worry about any part of it. Get your business
Right.
up to thousands of dollars of sales, and then let's get in compliance. On $40 of sales, it's not worth the stamp on the envelope yet. You
Yeah,
got to
you
get
can
it.
sleep. You can sleep. You don't have to have a sleepless night over that.
Absolutely. They're not coming after you
And
for $40. They're
right.
not that
And
broke. They're broke, but not
Helen
that broke.
says when she registers for sales tax, should she put the date of her first sale? Will she be fined for not registering before her first sale? I think I know the answer to that.
No, you really need to put a current date. If you put a date from a year ago, they're going to send you notices for your failure to file for the year.
Kim corrected me. It wasn't $40 in sales. It was $40 in taxes, but same thing, really.
It's similar, although
Yeah.
collecting tax and not remitting it is kind of a bad thing. For $40, I wouldn't worry so much about it, but if you're going to be doing more in sales and if you're going to be collecting tax, then yes, you do need to register online with the New York State Department of Taxation and Finance. You can file your returns online, and they can electronically debit your bank account online.
Okay, sorry I didn't read that correctly. One thing I want to say that, Mark, you did not say is that people who fail to respond, if you register for sales tax and you fail to respond to the emails that you get quarterly, you will be penalized. So even if you have no sales, you must respond, correct, Mark?
You must file, yes. You always must file.
Even file 000, but you've got to remit.
Yes.
Otherwise, you'll get a penalty.
Yes.
Kim says she's registered and she's filed every year, but never made sales. So that's exactly the answer to the question that you had. I just answered that. I just mentioned,
Ronnie,
right?
Ronnie, I've got one here. Delia says, aha, what about if the customer is in Canada, Mexico, Brazil, and Germany?
No,
I don't really know foreign country taxes. But again, if you don't have nexus in those states, those countries, I'm not sure how they can regulate.
You answered that when you said about Russia. Russia can send you a bill, but we don't have any kind of agreement with Russia or Mexico or about sales tax. So, right? Isn't that?
Yes.
Hey, are there any? Oh, I see two more questions. Never made sales. No, I think you answered that already. Anything else? Are there any other questions? Anyone have any other questions?
Ronnie, I have a question.
Please.
Hi, Mark. Good morning.
Hi.
Thank you for the presentation. I might miss something at the beginning of your presentation, but I do have a question for the marketplace facilitator. So, for example, Amazon is a marketplace facilitator, and they are responsible to collect and remit the sales tax, right, for each state. So in this case, it really doesn't matter how large or how small the third-party seller is. Amazon is still collecting and submit the sales tax for them on their behalf. Is that correct?
So with a marketplace facilitator, the marketplace facilitator has the obligation to collect the tax for all of its sellers on their marketplace, and they aggregate all of that sales tax and remit it, regardless of whether those sellers are big or small.
Right. So in this case, so in this case, the 100K, the dollar amount or the 20 transactions doesn't apply for the third-party sellers, right?
For marketplace facilitators.
Right. No, not for Amazon, but for each third-party sellers.
If you're a marketplace facilitator, the state requires you to collect sales tax on all the transactions that go through your
on behalf of the third-party sellers.
What do you mean by a third-party seller?
Whoever sell on Amazon.
So Amazon has two different types of sellers.
Right.
Amazon does marketplace facilitation, and Amazon does fulfillment services. If you're going through Amazon as a marketplace facilitator, Amazon is the marketplace facilitator, and Amazon needs to collect sales tax on all of the sales made through its platform when it's acting as a marketplace facilitator.
Okay, so I think my question is, for example, a small business list their products on Amazon, right? So if they sell, their annual sale on Amazon is like $5,000, but Amazon still collect and submit sales tax on behalf of this third-party seller.
Yes, Amazon's going to collect tax on all the sales for all the third-party sellers on their marketplace.
Right. So in this case, this small business, for this small business, should it register for that state? Because Amazon already collect and submit sales tax on their behalf.
Yes, that company should be filing a 0 sales tax return, reporting its gross revenue and no taxable revenue.
All right, so they still need to register with that state,
Yes.
even if they didn't reach the 100K dollar amount or the 200 transactions.
Correct, but now you have to look at whether administratively it makes sense to do the right thing or administratively to maybe ignore it.
Okay, I see.
Well, I think what Mark said was originally is that every single solitary business, no matter whether they collect sales tax or not, needs to file the, whatever you called it, Mark, needs to file a return that's 0, whatever, right, Mark? Everyone needs to, sales or use tax. Everyone, whatever their business is.
All right, yeah, thank you. Thank you, Mark.
You're welcome.
So what else? So if you're a seller on a marketplace, you need to register in each state that the facilitator sells your product in, regardless of whether you reach the threshold or not.
So the answer is yes.
Yes.
But again, you may want to look and make an administrative decision that it's not worth the cost and expense of registering the state to report $5,000 in gross sales and $0 in taxable sales.
Okay.
So you need to weigh some practical considerations with that.
Yes, yes, I understand that. A lot of these questions I think I can answer myself, but about that bar TV, if the TV is in a back room and not viewable by the patrons, it is for sure taxable. If the TV is in the public area and it is part of the atmosphere that brings in the patrons to purchase taxable drinks, is the TV taxable? It has not, oh, I don't want to answer that question. You go, Mark.
It's absolutely taxable.
Yeah, doesn't matter where it is.
And chairs and silverware and glasses in the bar, it's all taxable.
Right. And I'm not laughing at the person's question. Believe me, I have plenty of questions that prior to the question, think this can't be a good question. But anyway, do I owe use tax on equipment purchased in a state that has no sales tax?
You only owe use tax if sales tax was due and not paid. So if you're in Delaware, which doesn't have a sales tax, and the seller doesn't charge you sales tax on something delivered in Delaware, when you use it in Delaware, there's no use tax because the use tax is equal to what the sales tax should have been, but wasn't paid. So when it should have been 0, you owe 0.
I want to tell you something. I do still have a lot of questions. It is a very complicated issue. And I thank you, Mark, for being here and answering all the little specific questions. And once again, I have to say, I am not laughing at the questions. I have a million questions that are probably, I think in my mind, I'm sure he answered that 4 different ways. But when we're talking about our specific situations, it does get very complicated. And Mark, you've created an entire business. I mean, look at all the people you have working with you. You are obviously, this is a big area of confusion. Okay.
Yes.
And it's getting worse now. I think with all the businesses that are now going online and selling and purchasing products and excuse me, it's even more complicated than ever before. So if you're open to it, people will reach out to you independently. Maybe they'll ask through me and I will reach out to you, and maybe we can do this again in a couple of months, because it's a really important question. You know, people have really important questions. Everybody wants to be compliant, or most people want to be compliant, and they just aren't sure what they have to do. So thank you, thank you, thank you for, you know, for being here for us today. It's really great information. Is there anything else at this point? I do see that there are other questions or comments. You can contact us. You can contact Mark. We're here for you. We want you to do the right thing. So anything else I haven't said, Leslie? I'm choking here.
No, I just put up letting them know we're going to send them a
Yes, important.
going to send them a survey. And also, you don't have to memorize this link down here if you can't copy and paste it. Hold on a sec. There we go. Hold on.
What link are you referring to,
Yeah,
Les?
there we go.
Oh, here you go.
Yes, you don't have to memorize that link or copy and paste it. It is going to be in your evaluation, in your survey. So,
Yes. So all of you here today will get a follow-up letter. Thank you, Les. Thanks, Les. Yes, everyone will get that letter. Thank you, Mark. You've been fantastic.
Mark, this was great.
It really is great. You know, it really, really is. Thank you, everyone, for attending. And if you have any questions, reach out to me. We'll help you. Make an appointment. We'll help you. Anything else? Thank you, everyone. Mark, thanks a lot.
Oh, you're welcome.
Great.
Thank you.
Great.